are surprised to learn they may be able to exclude up to $500,000 in profit when selling their property, their primary residence. Before assuming you'll owe capital gains tax, it's worth understanding the IRS rules and speaking with a tax professional. So today I'm here with Lisa. Lisa Nevada is with L.Nevada Accounting Services, and today we're going to talk about capital gains. So Lisa, what is capital gains tax?
Capital gains tax is an additional tax on top of your standard income tax that you would owe on the sale of any investments. So when we're talking about the sale of property, in most cases that's long-term versus short-term capital gains tax. So you would have to own the property for a year plus 1 day, and then it would qualify for the long-term capital gains tax rates. It's an additional tax that you pay on the profits received from the sale of property.
Okay, great. So for example, a single filer, it can save up to $250,000 in profit before they would pay any capital gains, and a married couple would save up to $500,000 in profit.
That's correct. And there are a couple stipulations to ensure that that actually happens. The IRS has a publication just available for all of us to read online regarding the sale of your main home.
Okay.
But a piece of that is called Section 121, and it kind of outlines the rules for using this exclusion. There are 3 pieces to it. One is that it has to be, you have to have owned the property for 2 out of the last 5 years. And then also have lived in it. You have to have used it as your primary residence for 24 months. Doesn't necessarily have to be 24 consecutive months, but 24 months out of the last 5 years in order for this to apply. And then the third test is that you may not have used this exclusion within 2 years prior to the tax year that you're filing and reporting the sale of the home.
Okay, great. And also home improvements can reduce the tax as well.
They absolutely do, yeah. When you're looking at your net profit, there's sort of a little equation that you want to keep in mind. So it's your proceeds from the sale minus your initial purchase price of the property plus the cost of any improvements that you made to that property. So if you did things like remodeled your kitchen, installed a central air system, new roof perhaps, you put an extension on the house, anything really that improved the value of the home, the cost of all of that work gets added to your original purchase price as well. So that's then called the adjusted cost basis of your home. So you're looking at the proceeds received from the sale minus your cost basis, and that then can give you a better idea of what is left on top of that then to exclude before you're trying to calculate capital gains tax.
That's excellent. That is great to know. So with that, the home improvements obviously can increase your home's cost basis and reduce your taxable gains. So it's important to keep your receipts and records, and for when you're ready to sell your home. If you have any additional questions, I highly recommend reaching out to your own tax professional. If not, feel free to reach out to Lisa with L.Nevada Accounting Services, or myself. Feel free to reach out to me if you should have any questions with this in selling your home.